Real estate investment trusts have long been thought of as a great source for income investors seeking higher than average income, as well as good growth in income. They're not necessarily always the greatest long-term investments from a standpoint of total return, but that may have changed here recently. And in this video, I'm going to cover 7 REITs that I think are extremely attractively valued now with good dividend yields that you can consider and do your own research and due diligence on. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Like I said in my introductory remarks, REITs are great income vehicles, but they haven't not necessarily always been great capital gain or capital appreciation or growth vehicles, but they always have thrown off a prodigious amount of income. By law, they have to pay out 90% of their distributable income to their shareholders or their unit holders. So that's one reason why REITs have been very, very popular. But in the environment of very low interest rates that we were in for the last, couple of decades, actually, REITs tended to trade at very high valuations. Well, as the Fed began raising interest rates again, just recently, real estate investment trust valuations have come back down to earth. And that's made them very, very attractive. We're going to look at what's been going on with these REITs, what their valuations looked like in years past, what they look like now, and more importantly, a little bit of discussion on what we might think might happen in the future. I'm going to be covering 7 REITs here, but I'm also going to show you an example of what I wouldn't consider a good REIT versus what I would consider a bad REIT. So let's go ahead and get into it. I'm going to start with Agree Realty here, but before I get into Agree Realty, let's go ahead and look at the 7 REITs that we have, and I'm going to look at 2 office properties income trust as one that I don't think you should be investing in. And I'm also going to be looking at Alexander Real Estate as a second office REIT. I'm not really too crazy about office REITs now, and I'll explain. All right, but let's go ahead and start actually this presentation by looking at Realty Income, which is the monthly income stock and considered the granddaddy, if you will, of all real estate investment trusts. Now, I want you to notice that initially we've always defaulted on FastGraphs to adjusted operating earnings. But now that we've created this smart metric, I want you to notice the tool automatically moves to funds from operations, or in this case, adjusted funds from operations, which is a preferred metric for evaluating REITs. Now, what I want to talk about with Realty Income here is the fact that what I like about this, and let's go ahead and take some of the things off of the graph here so you get a better picture of what I'm talking about. Number one is the adjusted operating results of this company have grown very nicely at about 5% a year historically, sometimes more, sometimes less. It's not a great growth story, as I pointed out, and we'll get into that more later. So this orange line is the fair value reference line. That's a 15 times adjusted funds from operations in this example. And I'm not going to get into explaining why that is, but that is what we consider the intrinsic value of the business, meaning that if the price was trading at that line, it was trading at intrinsic value. If it was below that line, it would be below intrinsic value. And above that line, you'd be paying a premium to its intrinsic value. So let's go ahead and put weekly closing stock prices on the graph. And this basically gives you some indications, other than the Great Recession of 07 and 08, where we had very low, single-digit price to adjusted funds from operations. For most of the period after that, you can see much higher valuations, even up into the mid-20s, where it was trading at 23 times price to AFFO. This was during the low interest rate environment. So if I put the normal price earnings ratio, which included these low years here, we see that it was averaging about 17.48. This is a trimmed average. The high and the low are thrown out. But if I shorten the time frame a little bit, we see that normal price to AFFO adjusted up to about 18. And that's what this blue line is. This represents a price to AFFO of 18.42, which was a high price. Now, if you paid these high valuations, we're here on July 8th, 2016, the price to AFFO got to 25. And if you'd have bought it then and held it to now, you'd have made less than 1% a year. You'd have lost 23% of your money in growth, but you would have picked up $3,000 in dividends. Okay, again, the dividend story here is really great. Now, from a dividend point of view, this white line is dividends, and as you can see, the company's paying out the majority of their AFFO in dividends. It's actually 90% of their distributable income by law that a REIT has to pay out. So you're going to see very high dividend payout ratios when you look at REITs. But the point is that if I'm looking at growth rates here, if I'm going forward on growth rates, if we go into the forecasting calculator, Realty income is now expected to grow at about 3.6% on average through 2026. That's 5% this year, 3.57% next year, 2.5% after that. The long-term growth rate is expected to be much lower, however, and that would have to do with interest rates. But the key point that I want to make is using a conservative 15 multiple here, if you bought Realty income today, you could make double-digit rates of return. You could get 28.6% growth, which is a 9.26% capital appreciation. And that's from the PE ratio, or the price to AFFA ratio, going from 12.9 up to the current 15 fair value PE ratio, or price to AFFO ratio that you're seeing here. All right, but the company is also expected to throw off about $1,800 in dividends. So original $10,000 investment would grow to $12,859 in capital appreciation, but you would also get another $1,800 in income, taking your $10,000, and this is not reinvested, by the way, to $14,665. Now, what's happened here, and I want to be crystal clear about this if I can, is the high valuations that were typically associated. I really like this REIT. It's A- rated. It has less than 40%, 36.9% debt to capital. The company is very well managed, considered to be one of the highest quality real estate investment trusts out there. Management is adjusting their business to the rise in interest rates, and they're going to be adjusting their cap rates and how they purchase real estate accordingly. Analysts think they're going to continue to be able to generate growth in the future, although it's not going to be as high as it was in the past. But the advantage is you can buy it now at a much more reasonable or attractive rate. It's actually got a margin of safety built into the margin of safety valuation that the orange line would produce. And when you're looking at forecasting, these future cash flows that are expected are being discounted by 3.62%, the discount rate that we use. These graphs are built on discounted cash flow rates, but instead of just arbitrarily picking a discount rate, we're using the growth of the REIT's cash flows or any stock for that matter, on fast graphs to be the discount rate. So that would lead us to, again, a 14.4% annualized rate of return based on the fact that we're getting growth of about 3.6%. We're getting 5.92% current dividend yield that is expected to grow. Okay, and then we're getting PE ratio, or price to AFFO expansion, from 12.9 to 15. That all adds up to a potential 14 or double-digit rate of return of 14.44%. But let's look at the income. Let's look at the performance of Realty income over time, and we're comparing that to the SPY. But I'm going to draw a different comparison here. I want to bring Pepsi. Pepsi is considered a blue chip income producing stock that also doesn't have great growth. And I'm going to take the SPY off the graph. Our new performance report allows us to do that. And what I want you to notice here is that Pepsi outperformed on a capital appreciation basis Realty income. The Pepsi did 7.3% compounded annual growth rate. Now, by the way, you can choose with our new performance report, you can choose cumulative change. So, Pepsi increased by 155%, or which you could use what I like better, which is the compound annual growth rate. So I'm looking at the annualized rate of return. So it did 7.39, where Realty income only did a price capital appreciation of 3.49%. Now, from a valuation standpoint, the orange and blue line here represent fair value for both of these entities. And, Realty income was trading at a 18.39 fair value at the beginning of this measurement, where Pepsi was trading at 20. Okay, and from a standpoint of growth, the AFFO growth, or the cash flow growth of Pepsi versus the cash flow growth of Realty income actually grew faster than Pepsi did. But the difference was we now find Realty income trading at a discounted valuation of 12.9, as I pointed out earlier, where Pepsi is trading at a 28 multiple. So measuring valuation without simultaneously measuring performance is a job half done. So long-term performance has definitely been impacted by the reset of valuation. But here's the part that I want you to really focus on. And we're reinvesting dividends here. I'm going to turn that off, and I'm going to look at this again without dividends being reinvested, because I want you to see the advantage that Realty Income or REITs tend to give versus even a blue chip like Pepsi. Realty Income would have thrown off $9,578 in total dividends on a $10,000 investment, where Pepsi would have only thrown off $6,572. A very good yield for Pepsi, but obviously, as I mentioned in my introductory remarks, a company like Realty Income or a REIT is all about generating the massive amount of income that they generate. And you can see that very clearly here. Now, the dividend growth for Realty Income has only been under 5%. It's an average of 4.87, a compound growth rate of 4.76 versus Pepsi's faster growth. But the difference then, of course, that I want to point out would be the fact that you could have got a much higher starting yield on Realty Income. But looking at it from here again, I want you to see the market was always pricing this at a high valuation historically. And, at times when it got close to being bought at fair value, you had opportunities to buy it at fair value several times going back to the beginning of 2011 here, the end of 2010. But most of the time, if you wanted to invest in this REIT, you'd have had to overpay for it. But look how valuation works. Here we got a chance to pay price to FFO just over 15, and what we end up with is, a price to FFO. We ended up getting an 8% rate of return on this stock, even though the valuation has gotten very low. I want to make that clear. If I was measuring this from here at its normal valuation, and I'll pick a spot where it was trading at its normal valuation, you would have made 11.19%. But the point being is that, the REIT was always trading at a premium valuation because interest rates are lower. But again, growth rates haven't changed that much. Okay, the analysts are still expecting growth. So even if you still get this at its historically, reasonable valuation, you can still make the double-digit rates of return I talked about. Now let's go ahead and let's look at some of these other REITs. I wanted to show you Office Properties Income Trust because I'm going to take everything off of this again, and I want to make a real strong point here. This is not the kind of REIT that I like. I want you to notice that adjusted funds from operations have been collapsing. The company shows an AFA fail yield of 65%, which is extraordinarily high. They only pay a dividend yield of 1.48%. And when I put the dividend on here, I want you to notice that they've slashed the dividend in recent years more than once and are expected to slash it again. All right, if I go back to Realty Income and look at Realty Income, again, they've raised their dividend every year. And the thing I want you to point out is the kind of companies that I admire are companies like Realty Income that have basically strung together a very consistent, although in this case not real fast, rate of growth. Now, by shorten this time frame, this has been a steady 5% grower during the low interest rate environments. Interest rates have gone up. It's now expected to be a 3.5% grower. But because the valuation has gotten so low at this point, it still gives us the opportunity to make a lot of money with a lot less risk than we'd have taken if we were buying it at these higher valuations. Okay, so let's go through some more of these other REITs here. Let's look at Agree Realty, which is a retail REIT. And once again, I'm only using, the 10-year time frame here, which starts in the beginning of 2015, where this REIT was reasonably valued. I want you to notice they grew AFFO at 5.94%. The starting PE ratio here was 14.28. It's now 13.92. So they've got a little bit of PE ratio contraction here. If I look at performance of this REIT, I want you to notice that it's averaged what Pepsi did over this period of time. Okay, it had the same rate of return. The compound annual growth rate for both was 6.49%, roughly 6.48 for Agree Realty and 6.49 for Pepsi. The compound annual growth rate was 6.19% for Agree Realty in terms of price appreciation. Compound growth rate for Pepsi was 6.94, and it was 6.16 for Agree Realty, but it pretty much mirrored Pepsi. So if we go down here and look at the performance report, what I want you to find out that's interesting, both of them, again, the annualized rate of return without reinvesting the dividends was 6.15%. Now, I want to make that clear. That's very consistent with the 5.94, we'll call it 6% rate that the company achieved. Okay, so by buying it at fair value, you're fully participating in what the business had to offer. But the advantage here has been the strength of the dividend income. They paid $5,696 in dividends versus Pepsi's $3,127 over this time frame. So they underperformed Pepsi on the growth a little bit, but because of the advantage of the dividend income, they actually outperformed it on a total annualized rate of return. And their dividend growth rate was once again smaller than Pepsi's, but because it was yielding so much more starting out. And now you can buy this stock at a 5.36% yield. It's a BBB rated company with only 32% debt, and the low interest rates have affected the future growth rate of this company, but it's still, again, expected to grow at about 3.5% or so. And by the way, if the Fed starts raising interest rates again, this dynamic can change rather abruptly. All right, so let's look at a couple others here. The next one I want to show you is Camden Property Trust. Now, this is a multifamily residential REIT, and I want you to notice that the market has had a penchant to apply a very high multiple to this stock. And so this stock was coming into 2022 massively overvalued. Okay, they had a great year, a 23% growth rate in terms of adjusted funds from operations, but then their funds from operations flattened in 2023, and we saw this reaction to the stock. But I want to point out this reaction to the stock price. We had a 47% drop in stock price, which was primarily attributed to the overvaluation and the stock moving into fair value for one of the very, very few times in history, recent history, that it has. The Great Recession brought it down to a very low valuation as well. And had you bought it at its lowest valuation during the Great Recession, even holding it at today's low valuation, you would have made 14%. Valuation matters, and it matters a lot. Now, this company also paid a very high special dividend in 2016. You can see that here on the graph. My point being is that the advantage here of owning this REIT over Pepsi is not in capital appreciation, because it underperformed Pepsi over the time frame here, but it did generate about the same amount of total dividends. Okay, so if I look at it historically here, we've got a 4.39% yield now. This is the first time we've been able to buy this particular real estate investment trust, since 2010 at a reasonable valuation. I dropped this off. The valuations have been very, very high until now. So, with interest rates, potentially rising, analysts are actually pretty positive on 2016 in this case. And so now would be a time to invest in this REIT. The next one I want to look at is Mid-America Apartment Communities. Once again, we see an example of a REIT that the market just got crazy on. Now, I want to point something else out. When stock prices get highly overvalued like this, that's the market telling you that it's misappraising the value of this stock. They had a couple of good years here, but nothing justified this massive increase in valuation. I want to talk to you about that a little bit. If you're going to be a successful value investor, I think you've got to recognize and accept and understand, and Fast Graphs really points this out as well as anything can. And if you're not a subscriber to Fast Graphs, by the way, you ought to be, because it really reveals the kind of company that you're investing in, as well as how the market has valued or priced that company over time. And I consider that to be absolutely indispensable advice for any investor. But the point I want to make is, by looking at the graphs I was just showing you on both of these last two REITs, and you saw the high valuations we saw in 2021, you got to understand the market was not accurately pricing the stock then. There's a distinct difference between market value and intrinsic value. And a true value investor understands that. So let's go back to Fast Graphs now. So we see that in Mid-America, this was a clear misappraisal. But I think all of these were misappraisals, if you will. The next REIT we want to look at here would be NNN REIT Inc. And this is a retail REIT. And by the way, you can go directly from Fast Graphs into the company's website and you can see, what the properties are and what kind of, properties they own by going into, investor services or the properties and leasing here. And you can see that, this company maintains a conservatively managed, diversified real estate portfolio subject to long-term net leases with established national and local brands. Okay, you can go in there and do that kind of work yourself. But my point is, once again, I want to point out the difference between the price action of a REIT like this and the operating results. This is a retail REIT, so they did have a little stress in COVID. This is COVID, marked here with this gray. But otherwise, they have almost an impeccable long-term record here of growing their FFO. They had a little problem during the recession, but they're still expected to grow going forward at 3 or 4% like all these REITs. But the advantage is now you can buy this at a 12.45 price to FFO, where in the past you had to pay these high multiples for it. Again, great returns on income. You can buy this with a 5.54% dividend yield. That's very attractive, like I said. Another one I want to look at here is Public Storage. Public Storage, again, is a classic. We see the market has always put a premium valuation, a 22 plus multiple on the stock. It's now trading at a much more reasonable multiple below that, but I would consider this one still pricey. And it's a self-storage REIT that has gotten, more reasonably priced. But again, it took the rise in interest rates to bring these REITs to attractive valuations. a.k.a. Realty is another retail REIT that had very, very high valuations. It's now come back into reasonable values, offers a 5.36% dividend yield. So, very, very attractive. And once again, I want you to focus on these high valuations. High valuations happen in the market. Don't believe that the market is always pricing stocks correctly. Warren Buffett, the great investor, once said it very succinctly. He said he'd be a bum in the street with a tin cup begging for coins if the market were always rational. A true value investor understands that there is a difference between intrinsic value and market value that the market will apply at any point in time. Going back into the fast graph, these were very high valuations, and you can see the result was with a little bit of bad news. What this does is provides an opportunity for any type of catalyst to come out and destroy the value. You could have lost money owning this REIT for all these years or made virtually nothing, including dividend income, even though it offers a 5.36% current dividend yield, by overpaying. Today, the stock is trading at a reasonable valuation with a margin of safety already built in by buying it at a 14.22 multiple. Going to forecasting, if it would go to a 15 multiple, that would be an 11.5% annualized rate of return. Again, the key is you'd be buying it today with a margin of safety built in. I think I've covered I'm going to cover VICI here. This is a REIT that owns, like Caesar Palace is their flagship product. Again, you can go into the internal links here and look at the corporate website. Caesar Palace is one of their big products. Again, a 5.62%, trading at a very reasonable valuation. Now, this one has historically traded at a good valuation. Average growth has been 6.5%. And again, it has very modest debt. And if I'm looking at forecasting now, it's expected to grow about 3.5%. And this is in spite of the rise in interest rates. Analysts have already taken that into consideration. There's a lot of analysts following this company and these REITs. The bottom line is I like real estate investment trusts now. Thanks to interest rates increasing, the attitude towards REITs has soured, if you will. And what you've got an opportunity to buy really attractive companies at really sound valuations for the first time in a lot of years. So going back to fast graphs, let's go ahead and look at the portfolios here and look at it in terms of things like dividend yield. Office Properties, which is a REIT I told you I didn't like because it had collapsing fundamentals, only yields 1.48%. But if I put this in order of highest to lowest, Realty Income is almost yielding 6% now. That's a great time, in my opinion, to buy it. VICI is yielding 5.62%. NNN REIT is yielding 5.54%. a.k.a. Realty is yielding 5.36%. Mid-America 4.67%, and Camden 4.39%. Public Storage is yielding 4.28%. It's one of the more expensive REITs. And then these two office REITs, I only show these because I wanted you to realize that I think there are still some issues with office REITs. So a lot of controversy with whether or not people are going to be coming back to the office post-COVID or not. Alexander would be the attractive one. Office properties, obviously not so much. These companies are, under a lot of stress. But the other 7 REITs up here, I think, are all attractive for the first time in a long time. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, showing you REITs for income. Remember that, as I pointed out in the opening paragraph, these aren't necessarily great capital appreciation. They are very stable investments, and they do produce a lot of income, and you can currently, thanks to the valuation reset, get some very high current yields on these stocks and some growth in income going forward. So I think, if you're looking for something stable in your portfolios, now would be a great time to be considering real estate investment trusts. Thanks for watching. If you liked the video, give me a like, subscribe to the channel. Take a real hard look at Fast Graphs. What a marvelous tool that shows you the business behind the stock and then how the market is valuing that business and lets you make smarter long-term investment decisions as a result. Thanks for watching. We'll talk to you again real soon.